This is Scott Becker with the Becker Private Equity Podcast. Today's discussion is GDP revised upward, the good, the bad, and the ugly. The third quarter gross domestic product was revised upwards to 5.2%. And that, of course, is a very robust growth number, particularly in an economy where interest rates have been rising so aggressively, and the Fed funds rate is up to 525 to 550 basis points. Now, the good news is that's robust and relatively full employment. The bad news is that we ought to realize that a lot of that growth is being fueled by government deficit spending. And so the reality is it's not necessarily real growth, or it's not sustainable growth, because sooner or later you got to stop borrowing to get growth. The ugly is that the story of China's growth over the last couple of decades, a lot of it was real growth as they tried to move to a more urban civilization, more technology-driven civilization, a little bit more business-driven. But a lot of it was false growth driven by government deficit spending that's now coming home to roost, as many of the things that borrowed, many of the firms that borrowed hugely don't really have those businesses to really sustain that borrowing, as well as the government investing a ton in building, but doing so with deficit spending. And so China, which has been this miracle of growth, is now showing that's not really that true miracle of growth. When I see this 5.2% GDP here, which is an outrageously high number in a high interest rate environment, I'm reminded of that a lot of this may be ugly and artificial versus real. So that's really the story of this. I sort of like the glasses half full, the glasses half empty. The glasses half full, GDP growth 5.2%, terrific. The glasses half full, it's falsely driven by debt spending, no good. In any event, thank you for listening to the Becker Private Equity Podcast, and thank you to our producer today, Chanel Bunger. Thank you.